is Shannon Smith from Smart Business Solutions Financial Planning. I want to talk to you a bit about today about business risk insurance and some of the different options. So we're not talking about, these are your personal related insurances, but we're not talking about business insurance such as operational type insurance or PI insurance or something like that. So what do I mean when we're talking about business risk insurance from a personal perspective? So these are often, a lot of business owners often have, unique risks that may not be adequately covered by their personal insurances. So this type of business insurance can be used to protect against the loss of a key person, possibly a drop in revenue, as well as providing to repay debts and protect assets from creditors as well. It can also be used to fund as part of a business succession agreement. So in the event that one of the owners needs to sell their shares, result of permanent disability or death, this insurance can come in and support that. So what are the types of insurances that we have? We have buy-sell insurance, and I'll go through each of these in detail. Key person capital insurance, key person revenue insurance, and then business expenses insurance. So if I go through a buy-sell arrangement, what's a buy-sell arrangement? So we have a predetermined agreed price. What it does do is it goes through how would you, resolve the transfer or ownership of shares if something was to happen. So you basically, what the beauty of a buy-sell arrangement, if you're actually agreeing a lot of this up front before you have the situation, which is obviously going to be a lot easier than doing it after the fact. And then it actually outlines the funding available to fund the transfer based on if there is this type of incident, how would that then be funded? So that's what a buy-sell arrangement is. Buy-sell insurance is designed to manage the risk of the business if one of the business owners is forced to exit the business due to illness, injury, or death. So when I talked in the prior slide about funding, often this is funded through the use of insurance. So the buy-sell insurance pays a lump sum that basically can ensure the business owners can acquire the departing entity owner's equity and continue to run the business. It also enables agreed compensation for the shares held at the time of that happening. And you're in a situation, obviously, if someone passes away, or TPD, there's going to be concerns about, and also what's the value. Now, some of that can actually be covered then in the buy-sell agreement so that it's very clear. The risks that can be covered by buy-sell insurance are the death of the partner, life insurance, your TPD, and also trauma insurance. Now, it depends what you want. So not always is trauma in there because some people say, well, if I had a trauma incident, I wouldn't, or they may have key person insurance with trauma, but they may not have it with the buy-sell of the business because they might say, well, I'd be out of the business 2 years, but I'd want to come back. So you can structure it in different ways that you want to. But the way I look at it is literally, I think every small company, partnership, any business should have a buy-sell agreement because it really sets out what will happen to the business if there's a specific event like a death, illness of one of the shareholders or partners, or if one of the business owners wants to sell their share. And it's better to get it agreed up front when everything's happy than having that issue come up later and maybe you're dealing with, the deceased partner. So buy-sell agreements are sometimes likened to, I guess you could say, nearly a business will, and they really help minimize the risks such as remaining owners needing to sell the business or take out additional borrowings to pay out the departing owner or their estate, assets being frozen due to legal issues created by the departing owner or the family or the estate. All of a sudden the departing owner's family, given they own half the business, have now decided they're going to become active business partners with you against the wishes of you doing that. The departing owner's spouse or family taking up their legal right to claim business profits even though they don't run or work in the business, and the departing owner's spouse or estate maybe even selling it to an unsatisfactory third party. So these are some of the reasons why it can be really important to have a buy-sell agreement, and the buy-sell insurance is how you fund that agreement so that there is a mechanism to fund that. So if I look at then how much to cover, so determine the level of cover that you and your business partner need. That really comes down to the value of each owner's share in the business. This value should be generally reflect the sum insured under the agreement, and it's important that you do actually review this. As the business increases in value, so should this insurance potentially increase in value. So if the business owners have, if the business has two owners, each of them have an equal share in the business, let's just say it's worth $2 million, then the amount insured on the life of each partner should be $1 million on the buy-sell life insurance agreement. That will possibly cover death, TPD, and possibly trauma as well, and that would be $1 million each. If I look at an important element also of the buy-sell agreement, which does link into obviously the buy-sell insurance, is reaching a consensus on how the business is going to be valued. Most commonly, it is current market value. So if you are a business that has had other shareholders come into that business recently, we have a value at that point. Otherwise, we can perform a business valuation, and you should be updating this regularly because you don't want to have where the insurance is not enough to cover the value of those shares at the time something was to happen. If that was to happen, you would still be finding extra funding to try and pay back that amount of the additional gap, I guess you could say, to buy those shares out. Other valuation methods might include, say, indexing the value with to inflation or expected business growth rate, but that is something that does need to be agreed up front. So when you're looking at these types of insurance policies, the devil is in the detail when it comes to ownership and taxation. Now, there's a few different ownership structures, and each of them comes with different tax implications. Now, when we're working with you to look at the most appropriate structure, this is critical for us to understand who the shareholders are, how they're structured personally, so that we can consider the ownership and the taxation to ensure we get the best outcome for the business. So depending on the structure, the different options available, it's self-owned by each of the owners. There's cross-ownership over the lives of the other owners, company ownership, trust ownership, and superannuation ownership. And some of the difference in those ownerships is basically, there is going to be, once we have a triggering event, there'll be different tax issues. Also, most importantly, to review your specific situation and the business and consider potential of ownership changes. For example, cross-ownership is not great if you're going to have a number of different potential ownership changes because you're going to need to get new insurance every single time. So we need to look at it and really come up with the most recommended structure for you. Now, what happens if you decide you don't want the buy-sell insurance? Because I will tell you, buy-sell insurance is not cheap. You are asking an insurance company to basically cover you as of today, if something was to happen today, the value of your shares of the business. Now, if the shares of the business, if your shares in the business are worth $1 million, you are asking the insurance company to cover and pay you or pay your estate $1 million from today. So I can assure you that no matter which way we go, the buy-sell insurance is not cheap insurance. So people do ask me, well, if we don't have buy-sell insurance, maybe we put a buy-sell agreement in place, because you should absolutely have a buy-sell agreement. But if you don't have the insurance, how are you going to fund the payout? So when a co-owner exercises the option to buy or sell the equity in the business, it's going to create a liability. And so how are you going to pay for that? The buyout of the departing owner, typically funded through insurance. But if you don't have the insurance dollars, where are you going to get the money from? One alternative could be some vendor finance agreement that you might have in your buy-sell agreement. That should all be included, or a combination of vendor financing and personal insurances. You might have a situation where you get insurance to cover, say, half of it, and the other half is vendor finance, which might mean that the business would pay that back to the estate or the departing partner over 5 years or 10 years or some other agreement. But if you do not have insurance, how are you going to buy these shares? What if you cannot get the funds to buy them? And then if you go back to my concerns that I raised earlier, you could have the business having to be sold, and we've seen these types of situations. So, it's a really important one to, as soon as you've got, the ownership of shares with other parties, you really do need to look into this buy-sell insurance. So what about key person insurance? If I move on to key person insurance, So key person insurance basically provides either a cash injection into the business to help offset the reduction or loss in revenue following the death or incapacity of a key person or employee. So who is a key person? Now, a key person actually doesn't have to be you as the business owner. You are usually, as the business owner, you're often very integrated in the business, and you are often that key person. But you also may have a key employee as well. So it's really someone who has a continued association with the business that really provides the business with a significant and direct economic gain. Now, when I'm working with clients and I'm looking at them from, a business coaching perspective, my goal is to build their business to make it to a point where you, in theory, don't have that key person. Why? Because it should be a business that's able to operate without reliance on one person to really be that key person. But the business owner is always going to be that person, especially in the earlier years. So it could be a salesperson, technical expert, silent partner whose reputation maybe gets you extra business in the door. So identify if something was to happen to them, what would happen to your business? What would happen to the revenue? So if I look at then, who the key person is, then we look at types of key person insurance. So as I said, we've got revenue insurance or capital. What we mean by revenue is that key person revenue provides compensation basically to the business for the loss of an employee through death, disability, critical illness, which may have an adverse effect on the profit or on the revenue of the business. And whereas key person capital is actually providing a cash injection. So if you have loans within the business, key person capital is critical. Basically what it does, if you've got a key person that generates a lot of the revenue for the business and you have a business loan that is heavily dependent on that, you may include key person capital as a way of getting a lump sum that would pay that debt out should something happen to one of the key people in the business. So the key person revenue is losing. It can cause your revenue to drop. You may actually have a drop. Maybe it's immediately. Maybe it's in a few months' time as sales start to taper off and you're fulfilling orders. And so the business costs can also increase. So the funds that you get from key person insurance would replace the revenue that key person would have generated. It will assist you in paying costs of the business incurred to find a suitable replacement. So hiring someone. And so that's basically going to be your key person insurance. Whereas the key person capital is replacing the revenue of the person would have generated and a lump sum, and it can be a combination, to actually help pay down some of those debts that you may have, because your revenue would have gone down and you may not be able to pay those debts. So from how it helps, from a key person revenue perspective, the cash injection will support the business during this transition, compensate for the loss in sales while a replacement, say salesperson is found, or key person, assist in recruiting costs, cover training costs if you need specialist skills, but also help manage organisational changes. So some staff may need to take on extra duties, have extra pressure put on them during that time. Then if I look at it from a capital perspective, this really helps to basically fill the void by offering an alternative funding. So if something was to happen and you were able to have your loans paid out, then the slight drop, maybe the drop in revenue would not be as significant, but paying those debts out would relieve the pressure. So, goodwill, if the client, what is it the client brings to the business? A loss of the key person with specialist knowledge may actually erode some of the goodwill value you have in the business. It may restrict your ability to have access to credit. Now, I've seen many business owners, and you may have, say, 2 or 3 business owners, and one of the business owners has been, I guess you could say, had assets themselves personally that they've been able to use to secure for funding for the business. Now, if something was to happen to that person as part of their estate, all of those assets would be a part of their estate, and they wouldn't be able to be used going forward as security for the business. So they're not going to have sufficient personal assets to basically secure the business debt. So, and it may be difficult to access further borrowing. So that's something that we could look at to see if you need to have those debts paid out. With that in mind. And then just there may be key person, if the key person loan money to the business, and this happens quite a bit, And then maybe it's a case of that, with the estate and wanting to pay that back. So that's looking at how we're going to help on that. Now, again, as I mentioned earlier, it really does come down in the ownership and taxation. Key person revenue capital must be owned by the business, and in most circumstances, the operating entity of the business will also be the owner of the key person capital cover, and it's mainly because in the event of a claim, the business needs to be able to receive the funds to pay the expenses or repay the loans. Now, the key person insurance for revenue purposes is tax deductible. When you would have a claim, it would be taxable. The key person capital is not tax deductible, but the proceeds would also not be assessable income. And that's mainly because it's capital and it's for a loan. There could be capital gains tax depending on the situation. So what are the alternatives if you don't have this type of insurance in place? Again, it's about how you're going to access those funds. You take out a loan to try and work that out. Lenders may be hesitant to offer money if they've lost the key person, or it may be at low, really bad rates. Cover the loss with company profits. If you've accumulated enough reserves for emergencies, you might be able to recover from the situation within a year of, say, a current year of profits. But naturally, it heavily depends on the value that this key person brings to the table. The other thing that you might be looking at considering also would be then having to sell off some assets to help raise some money fast. But you may not get your full value. So I guess I put the alternatives there because, again, as I said earlier, this type of insurance is not cheap. Now, it is important to remember that if you do have some of these insurances, you may like to look at your own personal insurances, because many of you will have life insurance, TPD, and trauma and income protection. Now, if this policy is in place with your business, and if something was to happen to you, you would get these funds, whether it be you've sold then the business or you get the funds as lump sum, the shares get sold and you get the money there. You may actually need less cover on your own personal insurances. So having it in the business will still then benefit you from that perspective. So that's something definitely to have a chat to us about as well. Now, then the last one that I come to is business expenses insurance. So this is where if there's a situation where the owner's efforts are largely responsible for generating the business cash flow, if the owner was unable to work, the cash flow would significantly decrease, and that could cause an issue from a business expenses perspective. This is especially important, I guess, if you've got a situation where you don't have a significant cash flow that enables you to have a good expenses coverage period. So I always talk to clients about, and it's become more and more important now with COVID situation, is do you know your expense cover trend? This basically shows how many days worth of expenses can be covered by your closing bank balance and receivables. So if your business is growing, cash flow is absolutely critical, and you will be continually using your cash flow to feed this growth. But what happens if the business owner is unable to work, which causes a significant drop in revenue and for it to cease? How do you keep paying expenses? Now, a lot of people during this COVID situation, if it wasn't for JobKeeper, would have exactly that experience. Business overheads, and not in every every situation are we going to have a JobKeeper that's going to come out and give us money like what we've seen at this time. So business overhead insurance really provides a regular reimbursement of eligible business expenses to that basically assist the financial viability of the business. So a bit like putting the business into hibernation, which is exactly what we kind of saw in this situation. But not every day do we have these types of situations. So the business expenses can be really good from that perspective to at least cover it. So the types of eligible expenses, rent, loan, interest repayments, not principal, business expenses, your wages, all of those types of things are then covered by that, so that you can make sure that you've actually paid that. So business expense insurance must be owned by the business, obviously, because in the event of a claim, the business needs to receive the money. And the insurance premiums are tax deductible. However, in the event of a claim, they will be assessable income. So the alternative, if you didn't have this, use existing cash flows in the business, obtain a bank overdraft or loan, and maybe use personal cash or equity to fund the business. So it really, with insurance, you're really coming down to, with insurance, about what level of risk do you want to take and are you prepared to take, or are you able to take, versus what you want an insurance company to basically take over that risk for you so that you can keep your business in the best situation possible. If you've got any questions, reach out. Happy to have a chat about your specific situation and see how we might be able to help you. Thank you.